What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is June 17th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk about the critical $20,000 level for Bitcoin and try to get an understanding here as to whether or not this has to be the absolute bottom or if there is range left to go here to the downside after an already over 70% correction from the all-time highs back in November. And outside of that as well, I do want to dive into the conversation around the altcoin market, as there's a really interesting trend we're seeing right now that I don't think anyone is really talking about here during all this fear. We've got lots of things to dive into today's video. Let's go ahead and kick things off. Now, I want to start here with Bitcoin. We're taking a look at the 2-week chart here. I'm going to go ahead, really kind of expand the chart here and dive into the price action. As mentioned before, if we zoom in here, we can see that from back here in November, we've had roughly around a 70% correction in price. This already alone to me makes me confident that I'd be comfortable dollar cost averaging. Again, if you're at this kind of discount range, even if we go a bit lower or we track sideways, this is where I'm fine putting in some money. And the really great thing about this question of the $20,000 support level is that overall, we don't have to pick the bottom to get a good buy. And that's the critical thing that I want people to think about here, not trying to trade too much during this uncertain time. And on top of that, focusing on building long-term positions for, again, capital that you have allocated for the next year or two, right? That you want to be able to hopefully hedge with and grow over time, right? So I would say that we're already within DCA territory. But I do want to point towards a very important reality that sometimes people miss when it comes to percentages. Now, it's easy to think, well, if we're down 70%, yeah, maybe we even go down 80%, but that's probably just a couple more $100 or a couple more $1,000, right? Well, not exactly. It's a pretty decent ways down from the all-time high if we really have the kind of typical 80% plus correction that we experience in traditional bear markets. And I'll just go ahead as we're taking a look at the log scale. That's very important here. If we just simply drag down the chart, we can see that an 80% correction would take us down, in a sense, back down to where we were here at the beginning of the month in October, or here at the resistance point here for the mid-cycle rally in June of 2019, roughly around $13,500. That's generally what an 80% correction would do. And again, it is important to understand that all the while corrections usually have gotten weaker over time for bear markets, i.e. the percentage decline. At the same time, most bear markets are slightly above 80%. Some of them have been near 90% in the past. So again, just trying to keep it rational here, trying to keep an understanding here that we might have another capitulation candle here over the next week or so. And again, we might get a swift rebound, we might get some chop there, who knows? But essentially, I wouldn't just go ahead and go all in at 20K. Or at 19K, right? Start to average in. You know, it's already at a nice favorable discount range. And from there, you can continue to build more positions over time. That is, if you do have that, again, a disposable income that you can put into the market here. And again, if you've already gotten hit here from the correction, guys, this is again why I focus on like really on a macro perspective. If your investment position is for multiple years out, there's no reason to absolutely trade out of all your positions after 70% correction. That's exactly what smart money, DCAers, a lot of other players in the market would want you to do. And to be honest, all the while, if you guys have followed me on the channel, I'll say it here first. We were wrong about how heavy this correction would be. I'll own up to that 100%. At the same time, I don't want you guys getting burnt trying to, go against a revenge trade essentially and sell everything out. And then, oh, lo and behold, all of our ideas that potentially might go to 15K or 17.5K where we can potentially dollar cost average. What if it turns out 20K is the bottom and it just absolutely accelerates off of it, maybe because the Fed reverses course or oil or natural gas prices go down and therefore inflation starts to crater down as well and asset prices go up. You never want to get too confident on the trend here, especially when it's so strong right now. The only thing we can do right now is accept what has happened, right? And plan from here on out. And we have to think about what we want to do for the preceding year or so if we do have that disposable cash to invest, right? So that's probably where you guys are here in this case to kind of talk about what would be the next step here. What's the best course of action depending on where we are right now. Now, all the while we've talked about this essential kind of like $14,000 range or $14,500, right? coming up here to where we are now, this is what I would generally see as DCA territory. So you can just go ahead and kind of essentially, I'll go ahead and get the proper tool here, just kind of to draw it here on the chart. I would say anything within this range here would essentially be DCA territory. You're buying in at a good, favorable price here, historically speaking. Equivalently, again, if you want to put this against like another cycle here, just to kind of put it into context, we had a 70% correction here, very similar again towards the consolidation period we had for nearly a year here in 2018, thereby leading towards the full 80% correction afterwards. But even if, as much as people were so upset back then if they would have bought it there in that range up there, lo and behold, if you would have bought in this range here, it would have taken, essentially, let's just say you bought here exactly in January 2018, it would only have taken less than a year and a half to get back into the green here off of those lows. And then slowly but steadily here, actually quite swiftly, this is one of the fastest recoveries for Bitcoin, you'd be up here on your money, actually essentially double in Bitcoin's price here from the June 2019 highs. So again, it's essential to understand here that you don't need to pick the absolute bottom. It's just a key reminder here, guys, for those who are trying to absolutely pick the bottom, speculate too much on leverage. Sometimes it's best just to dollar cost average. Play the long game here, right? Again, it's not the death of Bitcoin here. More essentially, though, we're seeing a massive deleveraging with all the developments going on with Three Arrows Capital, a lot of the concerns around many providers like Celsius. We've got to see how that all manifests here. We don't know how over-leveraged some of these players were in the market. And in order to get that information, we've just got to simply be patient here and do the on-chain analysis that we can do with the resources we have. If you guys would like me to cover into that topic a little bit more in regards to like Three Arrows Capital, Celsius, there's a lot of interesting developments going on, some certain price levels we should watch for. I don't know everything. No one out there knows exactly all that's going on. And I think that's, again, why we should keep a bit humble here, especially seeing as how harsh the correction has already been, that we might continue to see lows below 20K here. We usually wouldn't see something like this, but hey, another great example here is that we usually didn't have mid-cycle rallies that recovered as fast as the rally into June 2019, and we certainly didn't have the kind of mid-cycle corrections that we saw back here from June of 2019 to February, March of 2020. Like we did, but it's because of the derivatives and the leverage and the credit in the system that we can get these big wicks here in the market where there's massive capitulation and massive runs to the bank, essentially, for people to cash out of crypto. Now, the next thing I want to talk about here that is probably one of the more reliable, unfortunate downside plays that we should expect here in the coming week or so. I'm not saying, again, anything is guaranteed, but I would say that according to history here, Ethereum has probably got a little bit more downside against Bitcoin. It could mean that Bitcoin really pops up well and Ethereum doesn't really follow suit as much, but the key thing that I want to point out here is the ETH to BTC ratio here. We've been on a pretty severe decline since back here in early May, and similar to previous history, after kind of blow off tops in the market, all the while we didn't get anywhere near the kind of momentous rallies here against Bitcoin that we saw back here in 2016, 2017, and 2018. All the while here, during this range here, when we tend to roll over and correct, like we have here, we tend to have a multitude of red weeks until we come down here towards this support range that's been general resistance in the past as well as support. And that is essentially 0.0378 to 0.04 BTC. That's the kind of range I would look for here for ETH to collapse. And that means we've probably got another 25% price decline here on the log chart. Looks pretty healthy here to come down to that range, turn some of these areas during the mid part of the cycle that were previous resistance into new support, and allow for Ethereum to eventually have the foundation to climb up higher. And that would generally align here with the long-term trend. If we look back towards 2016, we can see here that the long-term support for the ETH to BTC ratio has been setting in these higher levels. And that might give us the foundation where during the next bull market, during the next optimistic period of crypto, Ethereum could really surge higher and potentially, at least for a short while, or maybe for the long term, test for that #1 spot in the crypto sector. Who knows? Again, I don't think that it's going to be easy to claim the #1 spot and hold it long term, but we've seen Ethereum flip Bitcoin temporarily in the past. I think we could see it during the next wave of optimism here. So that might be a great discount opportunity if you want to buy something that could outpace Bitcoin during the next cycle. Again, we don't need to go too crazy about it, right? And again, similarly here, we saw the same here with this general resistance point serving as resistance over here, as well as a midpoint of contingency for price back in the past. Now, all the while, I think you need to keep your eye on the NASDAQ, keep your eye on what's going on in oil and natural gas markets in order to understand when inflation is going to cool and if assets are starting to appreciate in general, because we are definitely seeing a strong correlation between crypto and traditional assets in the equity markets. I think the important thing that I wanted to talk about here today has to actually do with the altcoin market. Now, most people, when they're looking at the altcoin space, they're usually analyzing what's known as total 2. And this is market cap in the cryptocurrency space, excluding Bitcoin. And all the while, that's a pretty good way to measure the value of the altcoin sector. There's a couple things I like to remove as well to get total 2 a little bit more detailed. And you guys can build this custom ratio yourself as well through TradingView. So what I've done is I've taken total 2 and I've subtracted essentially Ethereum and USDC. Now, there are probably some other stable coins out there, other things that we definitely want to keep in mind here. And I also removed Tether as well. I almost forgot to mention that. But within this, I've added parentheses, created an equation here, and divided it by Bitcoin. And I think what this shows here is a really interesting and valuable chart we can utilize for our trading strategies here. And I want to go ahead and I'll take it here towards the weekly chart. And you can just start to see here how this chart might be actually starting to see a little bit of a relief rally here, where we might be able to continue seeing some recovery in altcoins here, especially as Bitcoin potentially regains some strength in the coming days or weeks. If we get a rebound, we can see here just in the past week, actually in the past 4 days, mind you, we've seen altcoins go up essentially 14.5% against BTC. And again, this is excluding ETH, it's excluding USDC and USDT. All the while, ETH has a lot of concern because I think a lot of people are worried about Three Arrows Capital and a lot of these macro factors that are going to cause potential sell-side pressure on ETH. We're seeing a whole range of other altcoins actually trending higher over the last 4 days. And again, this isn't just something that happened overnight. It's been over a multitude of days here, right? We really kicked it up here on June 13th, up 6.3%, and essentially have come back up and held this range up here, similar to where we were back in May 12th to May 13th of 2022. Now, again, it's understandable that the dollar value has declined here. But what I really find interesting is that as fear is growing stronger and stronger, as bearish sentiment is picking up, altcoins are getting a pretty stellar rebound. And again, if you need to see what kind of coins are doing this, look no further than the layer 1 protocols. We can take a look at ADA BTC, right? We can see we've tracked up here from the lows here around 1500 all the way up to 2300. I think along with that as well, we've got Solana against BTC rallying back up again, back to that May range here. We've got EXRD. Again, this is one of our long-term plays here that we really like. Let me see, get it right here. ETH USDT, right? Signaling a lot of strength here back to where it was in February against Ethereum, right? So this is really interesting stuff here. Doing the ETH pairs, doing the BTC pairs, you can see a lot of signaled strength. And one of the altcoins that I do want to talk about today that is our sponsor for today's video is one that we've covered as far back as, I think it was 2019 or 2020 on the channel, and that is Kava. Now, if you guys haven't heard about Kava here on the channel, Kava is a long-term play in the crypto space, and they're one of the big layer 1 protocols that's been really accelerating, not only bringing in the EVM compatible layer 1 environments, but on top of that as well, the development ecosystem from Cosmos. So Scott Stewart, who we had on the channel for an interview a little while ago, has really been pointing out to the fact that Kava has been lightning fast at accelerating since it launched Kava 10, its new mainnet protocol. That's combining again the powers of what's offered within the Cosmos ecosystem, one of my favorite alternative layer 1s. It doesn't get hyped enough. It's really quality. There's a lot of great projects building on it. And of course, the EVM environment. Most of the applications you're probably used to, whether it be applications like Uniswap or Compound on the Ethereum blockchain or on other networks like Avalanche that have different consensus mechanisms. combining the systems and developer tools to allow for liquidity to essentially kind of fall into Kava like a vortex here. And you can see here that they've had a lot of great accolades just in the past week of their initial launch. They now have more protocols in TVL than Algorand, a layer 1 protocol that's been around for the past couple of years. And outside of that as well, more protocols in TVL than Tezos. Again, another legacy layer 1 play from back in 2018. And I think this is really exciting because there's a lot of key reasons why you're seeing TVL start to expand. And it has to do with a lot of the developer incentive programs that they launched, as well as a means for developers to essentially own the network here through the Kava Rise program. They basically minted a lot of Kava tokens, and they want the network essentially to be owned by developers. And I think that this is so nice, especially as we're going into a bear market, to have the founders, in this case, of the protocols that are building value on chain, bringing TVL, bringing liquidity, absorbing it from other layer 1 protocols, and bringing it to Kava in order to build value for the users. I've seen no one do it to this extent, so I'm very excited to see how it goes. It's a big challenge to overcome building a layer 1 in this environment, but usually the value is built during bear markets, not bull markets. It's built during bear markets, it's realized during the bull markets. So definitely keep an eye here on Kava, take a look at it. Again, not advice in this case to go out and buy it or anything, but it has held up quite nice here since back here in mid-May. Again, like a lot of these coins against Bitcoin, probably not what a lot of people expected here in regards to the market. Now, the last thing I wanted to talk about here as well is that if you are going to be trading in the short term, guys, because I know, as I emphasized earlier, it's best probably not to trade this market, but there is some good volatility in both directions. So I want to say, if you guys are going to be trading in this market, you need to be tracking as much market data as you can get here and try to understand what's really driving this market. You might be asking yourself, if I were to ask this question, you might have an answer for it. Who's winning in this market, the bulls or the bears? Well, one could argue that the bears are definitely winning more than the bulls. But there's a third person in the equation that many people don't think about, and it's the exchanges. It's the derivatives platforms. The people, you guys know, I'd be like a dead horse here, are ruining and wrecking this market. And to be honest, as traders and investors, some of us are guilty of it. We're playing into it to some degree. But the derivatives platforms here have really started to distort markets here. And if you aren't on a platform like Bookmap here, which is one of our partners here on the channel, one of my favorite tools outside of TradingView, if you aren't tracking the liquidations on the market here, it's so much more difficult to trade the short term in regards to the market. Again, as I emphasize here, I don't recommend most of you guys trading the short term. It's only something you do if you are disciplined about it, if you've had success day trading, if you can outpace your long-term investing portfolio. And I, again, would always recommend that if you're going to start with trading, start a small portion in this case, right? So you're not losing or risking everything. I know it can sound great and lucrative to just go all in, but again, keep it moderate. Learn from mistakes, build up a strategy, follow the right people out there. And again, we have a great trading tip series here on the channel and stuff, but I would highly recommend you guys check out the liquidity tracker. If you guys use the link down below in the description, you can sign up for one of the paid plans that will get you access to the liquidity tracker. But again, you can also use the standard free tools the Bookmap offers from their aggregate, their order book in this case, as well as the CVD that will give market order flow. So definitely check it out, guys. Give it a try. I'm keeping an eye on it here as well. I think one of the biggest things, one of the big X factors that we're waiting for is getting further clarification on what happened with Three Arrows Capital being one of the biggest funds in the crypto space, a legacy hedge fund in the crypto space, ironically. Not so good at hedging, but again, hedge funds have gone under before. The major thing is this. Whenever the news comes out here about what happened here, this is one of the few things that is probably going to cause another major cascade of shorts in the market that are going to drag down prices, or a short squeeze, essentially. So we really have to kind of play it neutral, don't take too many bets right now, and wait for this news to come out here. Once that news comes out, it's going to help us validate a much more solid trend, which can give us great trading opportunities, maybe even a relief rally to deallocate some of our positions. And if it drags us lower, in this case, great DCA opportunity. Play it both ways. Don't try to absolutely bet everything on one singular direction. Let the market do its stuff. We're already down 70% here from the all-time highs. It's best to wait it out and see what happens here over the coming days and weeks. Hopefully we'll get more news on that, and you guys know we'll be covering it here on this channel once it comes out. So if you guys enjoyed this video, consider dropping a like, consider subscribing, and if you guys want to leave a comment down below, let me know your thoughts on the market. That being said, everyone, thank you so much for watching, and I'll see you all in the next one. Take care, everyone.